Yeah, so that's always the plan. So I
Yeah.
think yeah, it's going to plan as I always kind of planned it this year. So yeah, I'm happy to yeah, probably after, end of this year, start next year, look at a single project, obviously with your support. And yeah, still open to joint ventures opportunities as well, because I know you always have the
Yeah, that's
the
right.
hottest
Yeah.
team in town. So
Right, yeah. I'm going to recap very fast over like sort of 30 seconds, 1 minute. So I
sure.
only just started the recording. I realized we've been speaking for a few minutes. We actually started the content. So this is what sort of property investor am I? And it's like sort of we're going to be going directly into the content now anyway. But it's yeah, looking at hands-on, hands-off, doing something completely yourself or doing it joint venture with other people, like different paths to take. And it's really important to, yeah, like review individually where you're at and what you want to do. So, yeah, what sort of property investor am I? So, yeah, the aim is, yeah, to think about it. And hi, Kathleen, to, yeah, come to some conclusions. So we can also start by asking the question, what do I already know? Because obviously knowledge in property is key and it's really important. And it's good to, yeah, maybe everyone listening to this, take 30 seconds, possibly even write down on paper or make some notes. What do you know about property? What have you already learned? Maybe from listening to other people, maybe listening to webinars, maybe from projects that you've already done or that you've taken in part in with other people. I don't know if anyone wants to answer this question from their point of view. Is like, yeah, go ahead, Keith.
I think like most people, you own a property, you own residential. With me, this particular things, I'm an engineer by trade, so I got involved with quite a few DIY projects around my house. When I say got involved, I actually did a lot of things myself, so I had an understanding of all the aspects of what's required, so I'm quite handy that way. Um, uh, Again, at a point of time, I bought an HMO from via a cousin who was doing it. Again, learned from her, built up some knowledge that way with the aspects of HMOing, all the law, regulations, room sizes, all the council stuff. So I was able to bring the practical aspects together with the legal aspects of dealing with tenants and all the rest of it. And then slowly but surely went on and found about networking, realizes millions of other people out there trying to do the same or similar things. So then you start getting involved with other people, seeing, maybe having a coffee, popping around, seeing what they're doing. That then led me on to doing it led me on to a JV, again from networking online years ago. What I learned from that is that it is quite tough going if you're trying to do it on your own and you're still working. Luckily for me, the person I was involved with, we JV together. He was remote living in Bristol and the project was down the road. So it worked between the two of us that I was the local person on site and he was a guy more remote ordering and this scheduling things just to take some of the load off my back. So what I learned from that is that I really do need to partner up with somebody if I'm going to be doing proper, equity type projects or BRR projects because of the time.
Yeah.
So what I've done since then is I've done more loans with other people, getting involved with their projects.
Yes.
And then, using the experience I've got to keep them on the rails of things. And basically what my next step is going to be is to retire from my work and do things full time, because now also along the way I've realized the power of networking. I mean, I say
Yes, that's right.
networking in all aspects of it. It'd be mortgage brokers, builders, if it be QSs, structural engineers, you need the whole shebang. Basically,
Yes.
I'm at a stage where if I find something suitable, with the right partners, I know I can go forth with it.
Yeah, that's good. Yeah.
But
Look,
that's
I want to ask you a little question, Keith. Did you do any like training courses on property, or was it purely through like doing some things yourself and networking with people?
okay. Yeah. I mean, yeah, along the way, again, I got in my early days. I was involved with Progressive. I
Yeah,
didn't do any of their major courses. They used to have an event at Wembley Stadium, so I was heavily involved with that. You know, as one of the crew manning all that. So I've done, like I said, I have done courses. I haven't spent a fortune on courses. I know you can get carried away, but
that's the, yes.
I've done quite a few, like the normal evening seminar in a week or a weekend course here or there, relevant
Yeah,
to what I'm trying to gain.
yeah.
Uh, yeah.
That's a good comment because I wanted to ask that specific question to make my own comment on that. In that, and I'll also like give a little bit of my background because I started probably about 8 years ago, and effectively I was going to quite a lot of these. There's quite a lot of groups like Progressive is one of them, Pin Network is another that do relatively inexpensive weekends covering like the different property strategies. And as long as you don't get carried away and like go to the back of the room and subscribe to really expensive things, it can be a really good way of starting off. And as long as you can get a lot of basic education from there. There's also, probably most of you know that I've got the YouTube channel and most of the webinars are on there. And it's possible to go and listen to them for free, possible to pay 20 or 30 pounds and go to a network meeting and all that. It doesn't break the bank to get education. And then sometimes some people effectively, if they want to really scale up and do something fast, it can be worth paying. And obviously there's a non-negligible cost for that, like for some real mentorship. But then if it's someone that is really basically got the time and has got like, in inverted commas, like an aggressive plan to get so many properties in the year, then it is worth paying to have someone to basically say, look, get on with it and guide you through the different things. So yeah, what you already know, education is key, but it's not a question of expensive courses. Reading, networking, listening to people talking about their projects. So let's see what we've got on the next slide. Yeah, so what are my goals in investing in property? So again, I'm going to leave that unless someone wants to, in 30 seconds, give their take on this. Obviously, it can be for creating income so that when to be able to replace work income, so that after a specific amount of time, maybe someone might set them to 5 years to have enough income from property so that if they want to stop working, they can do so. Or if they want to continue working, they're doing it because they enjoy it and not specifically because they need to do that for the money. Some people might be doing it more to create a legacy for their children. There can be lots of different reasons, but it's good to do a little bit of self-analysis and determine and maybe write down what are your reasons for investing in property. Would anyone like to make a comment on that? Yeah, go ahead, Keith.
I'll go ahead. So presently my plans are to make 200K over the next 2 years. So that will allow me to move on from my place of work, do,
Yes.
do property full time. And one of the main reasons I want to raise 200K is I've still got a mortgage on the house and some other little bits and pieces. So I like to be able to clear the ground so that
Yep.
do it full time, but you don't have a mortgage or rent or whatever to be worrying about. It's just the basic bills and expenses
Yep.
to get on with. So that's basically where I am for the next 2 years.
That's great. Yeah. What is important is this isn't like a goal setting webinar. We can do that another time. But effectively, see, like sort of a reminder, Keith's talking about 2-year goals. Often we talk about yeah, we'll talk about sometimes 5-year goals, maybe what income you want to generate, size of portfolio. But then starting from 5, it's always then needed to break that down into individual years. And then obviously, depending on how active, break that down into individual months. And if you're someone who's like actively doing it yourself, like for example, who's decided to potentially source properties yourself, contact agents, etc., do viewings, then you're going to be going down as far as a weekly schedule. So this is a next step, taking stock of existing property investments. It could also be people that are doing stocks and shares, maybe crypto. It's worth including this in it as well, because you can see on one side, this is the amount of stocks and shares. And someone might think if they're almost only doing that or got a certain amount of crypto, think what's my plan to diversify? Obviously, crypto is very volatile, but still possible for people that know how to do it to make money there, but there's always risks. Stocks and shares are less volatile, but obviously still have some risks. And property is, probably a lot less volatile. And if managed properly, doesn't have that many risks in reality and potential. We all know that property has the potential both for ongoing income and capital appreciation. So just a light reminder, take stock of what properties do you own. That can be owned outright, or it could be if you're in a joint venture where the aim is to hold property for the ongoing income. You can consider also the part of that property that you own. Take stock of what joint ventures or development loans that you have underway. Sometimes development loans are combined with what we call earn and learn, where you're lending on a specific development, but at the same time you've got access to what's happening there, Zoom calls, site visits, and basically learning along the way. And then also some people are doing, often it's more a question of getting started to generate cash flow, to be able to use, and also getting rid of experience how certain things in property work. Some people might be doing rent to rent. Typically rent to rent will be rent to HMO, renting at a fixed price, a 4, 5, 6 bedroom house, either with the objective of getting approval and HMO license, etc., or rent to serviced accommodation. So take stock of what you already have. I've listed here 4 choices for getting involved in property investment. And afterwards, you're going to be looking at whether hands-on, hands-off, etc. So first choice is to start doing yourself and learn by trial and error. So buy something, realize afterwards that it wasn't a good idea to buy that particular property, or take that particular mortgage, for example. So obviously we're not recommending doing that. The objective here, by the way, is not to sell training courses. We do mentorship, but that is probably only for like a select few who can really benefit from that. So a choice is to get training, mentorship if needed, to succeed in your own projects. And as we were saying earlier, training isn't necessarily expensive. Training courses, it's going to free events or events that are quite low cost, taking part in webinars like this, listening to recordings, etc. And then we've got the choice of joining effectively an earn and learn project with an experienced investor or developer. I know that Keith, I think you've done that a few times. Yeah, Sam is in one of our earn and learn projects. That's really useful because obviously you need to choose carefully the project, be sure that it's a valid project, that is someone that's got a track record of doing successful deals. But yeah, it gives a possibility of obviously getting some return on capital that someone has available, but more importantly, yeah, getting that experience, and you'll learn a lot more from doing that than putting that money in in some training course. Or then we're talking about possibility of a hands-off investment in a specific deal, which that's typically a joint venture, which can either be long-term. So long-term investment is when it's a joint venture where the aim is to hold a property. Obviously, it's shared between different shareholders and get the ongoing income from that. And that's for people who want to like grow a portfolio but don't want to do it themselves. So that's like basically the opposite of getting the detailed training to go and do something yourself. And then we've got the hands-off investments in a specific deal also on a short or medium term. Typically what that means is putting equity in a project where is going to be some sort of development, and with the possibility of getting that equity back after maybe 18 months, 24 months, with a share of the profit. So we've got different choices to review. And yeah, it's like important to understand where you're comfortable within those different choices. We've actually, let me just go, because there we're talking about different project types. We'll go back to the different choices. Are there any questions maybe on that part, or any comments on that part? Good, no questions or comments. We're going to move on. So in property investment, we've got obviously different types of investment that we can get involved in. And quite a few of them we can either do completely ourselves, or we can do in partnership with other people. Typically, the standard buy-to-let, you're not going to be doing that in partnership with other people. That's something that basically you're going to be doing yourself. However, when we're talking about the standard buy-to-let, we've still got the approach of doing it hands-on. The full, complete hands-on is learning how to find a property yourself, sort out the lending, manage the or subcontract the renovation, decide what to do with it at the end and get it rented out. So that's the hands-on method, which obviously needs and it's useful to have training on that, or do an earn and learn project. And then at the other end of the scale, you've got the completely hands-off version, where you'd be paying someone to find a suitable deal. Obviously, someone that's got experience, someone that can demonstrate that they've already done their own projects and know how it works, and can give you examples and figures from that. So yeah, you can be paying someone to find it, having someone manage the renovation, and even having someone find the agent and get it rented out, or finding the company that will do, for example, a supported living or a social housing contract on a long lease. So again, yeah, that's the, let's say, entry sort of level type of project. But again, the decision within there is hands-on, part hands-on or hands-off. Sometimes it might be a builder who's got some experience and wants to be hands-on on sorting out the renovation, but doesn't have the experience or maybe the time or knowledge of an area to find the project. So there he'll work with someone who can source it, and then he'll look after the renovation, and then maybe come back to the person that sourced it to help him find how to rent it out. And a second thing on the buy-to-let is typically we're recommending to go for the BRR strategy. So what this means is on a complete standard buy-to-let, what that means is we're looking on Rightmove and we're finding a property that's completely finished, possibly even tenanted, that we buy, we put our deposit in, we use bank lending for the rest. But our deposit money that we put in there is basically stuck for a very long time in that deal, because we have to wait until property prices go up before we can potentially take out the money. When we go for the BRR strategy, it's obviously more intensive, but here we're finding a property that needs a lot of work done on it, so we're getting it at a low price. Often we're getting stuff in auctions. We're then spending money to do the renovation, but with the aim that the end result is a higher value than the money that we put in, so that then we can refinance, so remortgage at the higher value and get a good amount of our capital out to immediately go into the next deal. So that's basically the accelerated way of building a portfolio. But the key question is, are you going to do it yourself with your time, get some experience and do it, or are you going to do it hands off with someone that will look after it for you? Next one, let's say next one up on the ladder is HMO, housing multiple occupation. Generally, they're also occasionally this might be a joint venture, but also more often than not, it's an individual investor, or it might be a couple of friends or family members that are coming together to again to buy a property, get it renovated or converted, and then refinance it and operate it as a HMO. We go for HMOs because for the same size of property we get a higher income, because obviously we're renting out by the room. Also, there obviously HMOs have got a lot more compliance issues. The renovations are more complex. And again, we can choose to be hands off. So we're having someone source it, having someone look after all the renovation, and then even potentially renting it out and managing it. And we obviously, you need a lot of time for this. It's not simple, but it's perfectly possible to learn how to do it and do it yourself. Because I'm going to give the example of Sam. Sam is in with us on a earn and learn project on the conversion of a house into a 6-bedroom HMO. So he's going to get some of the basically some of the education on how this works. What are the issues that we have to deal with as we go along? And at the end of that, he's going to understand that it takes quite a lot of time. There's a lot of things that need to deal with, and then he'll decide, does he have enough time and also the inclination and the desire to do that, or does he want to do it with someone else, or just do a standard buy-to-let? Or is that right, Sam?
Yeah, absolutely right, Trevor. I think I'm more remote these days. I work remotely. So for those that haven't met me yet, so I'm an IT consultant.
Yeah.
And I tend to work remotely most of the time. So if I could actually combine that, being on site and managing work and meetings, it's something that I want to explore really. So the last 2 years I've not been going into the office very much, but when there's like an implementation, I'm on site to help roll out whatever we're rolling out, a software solution. Usually that's it. So I'm trying to see if I can work property and still work as well. But long term, obviously, want to go full time on property and focus on some ideas on an IT application that we have with my business partner. I think of so.
Yeah, that's good. Of course, So this gives you the opportunity of understanding, and bit by bit, you can actually make your decision. And yeah, you can end up deciding I really like this, and I want to full-time get into doing my own HMOs, potentially even going forward. If you're doing it full-time, you can team up with other people and do it even for other people.
Yeah.
There's no limit to what you can do in when you're doing stuff in property. Right, let's move on to the next one. Mixed use properties. So mixed use is typically properties which have got, some element of residential and commercial. So the most common one is when you've got shops on the ground floor and flats above. Obviously there the advantage is multiple income streams. You're not dependent only on the residential occupants. You've got income from the commercial tenants, which typically are on longer leases, like 5, maybe 10 years. And mixed use properties are also still can be joint ventures, but if it's something that already exists and just needs renovation, like it's possible to find in auction a standard, especially outside of London, to get the higher yields. To find some shop that is in maybe needs some work done in it with 1 or 2 flats above. That can be also a perfect BRR project, because BRR doesn't specifically relate only to buy-to-let type properties, because BRR just basically means we're buying at a low price, doing quite a bit of renovation work, and ending up with a higher value at the end to be able to recycle our cash. So this is another step up mixed use properties. And now we're getting in conversion projects, getting clearly into the realm of projects that have that need a lot of experience or understanding, and also a lot of time to successfully do them, and ideally doing it first of all, as I would say, as a joint venture with someone that has got a lot more experience in that, and then potentially with the aim of doing it yourself. Because obviously we're talking about planning permission, building regulations, management of construction. And typical examples are converting offices into apartments. So we're talking about either conversion to commercial to residential, or we're talking about commercial to mixed use, which means typically ground floor commercial could be offices, mix of offices and retail, and then flats above. We're in the process of starting one, we're going through the conveyancing at the moment, which is mixed use, and we're going to have, if all goes well according to the planning, 3 uses in the same building. We're going to have a ground floor, which will have mix of retail and offices. We'll have a first floor, which actually we can divide into 2 floors, which will have probably between 10 and a dozen serviced apartments. So that's C1 use class going to be. And then the second floor and loft area will be C1 residential flats. And on things like that, on these projects, we can often, for example, sell off the residential and then refinance what is commercial or serviced apartments and hold for ongoing income. So we've got a mix of things here. So that is like the next step up, but generally much better to go for a joint venture, at least for the first 1 or 2, before jumping into it completely yourselves. And then the other type of project, which we also do and always are recommending as a diversification, is having in the portfolio some pure commercial property. So that could be offices, it could be there on the right, it's like serviced office space, which actually can be quite profitable, or it can be like multi-let, multi-use with a mix of bit of retail, a bit of hospitality, a bit of leisure, like could be a gym, dance school, stuff like that. And obviously we know, well, quite a lot of the advantages of commercial property is, we got a lot less problems with tenants. And then the other key thing is when we buy a commercial property that is not is under-occupied or has got tenants in there not paying market rent, we're going to get it at quite a good, relatively low price. And then once we've done our what we call asset management, that means getting tenants up to market value, getting everything fully occupied, because commercial property value is based on the income. We can get a much higher income, and basically we're doing a BRR by, except it's not renovate, it's by asset management and then refinance, typically on 1 to 2 year, sometimes 3 year timeframes, to be able to pull all the money out and go into the next deal. Generally, these are bigger types of projects. Typically, is going to be minimum 500,000 purchase, generally more around 1 million up to several million. So generally here it's some people go obviously for the one directly, but quite a few people come in these as joint ventures, which generally we've got one on at the moment. We're about half funded so far, which is offices which are only half occupied, and we're expecting probably between 8 and 9 individual shareholders to come in onto that deal. Yeah, and then obviously everyone gets a share of the ongoing income. And depending on the project, on some joint ventures, the aim is people leave the money in for the long term. And when we refinance, like on the one I just mentioned, when we refinance in a couple of years, we're going to buy an additional property without any additional money in from the shareholders. Yeah, so consider also commercial property as a type of investment. And have a think, if you're thinking like 2 year, 5 year plan, how do you want your portfolio to be at that time? And I'm just going to mention in passing rent to serviced accommodation. It's not really property investment, because rent to rent is a business. It's renting a property from a landlord at a fixed rate and then subletting it legally, of course, in order to get a higher income, either HMO type or serviced accommodation. But although it's a business, because you're not like investing, buying property, it can still be like a good introduction to how, for example, if you're doing rent to rent on an HMO, you're obviously having to understand how licensing works, checking that planning is in place and everything else, which can then be like a stepping stone to start investing and buying your own properties. Conclusions: many routes into property investment. Yeah, align strategy with your goals, knowledge and risk level. So knowledge is important, but it's not necessarily expensive to get that knowledge. And yeah, determine goals and understand hands-off. Basically, the two big questions are hands-off or completely hands-on or somewhere in the middle. And then the second question is, in general, do things entirely yourself, buy your own properties, or prefer the option of joint ventures with other people? So I think we're ready for any questions, if we have any.
I have one on off the top of my head. I was curious. So with the rent to rent, the HMOs, is it true that student households are generally harder to provide for, to work with, as compared to one with, let's say, professionals in there?
I'm going to say answer that yes and no, because
Okay.
in the sense, and it's got a bit more complicated now with the renters' rights or reform bill coming in, because generally students, you've got the advantage that oh, sorry, I just did something on my screen. Yeah, students, you've got the advantage that they're there for a year and they're going to, when they're going to be moving out. So it
yeah.
can be easier to manage. On the other
Mm.
side, students generally don't know how to look after a property. They're-
Yeah, that's
Come out of their when they're in their parents' home, it's their
yeah.
parents that change light bulbs, it's their parents that do their washing, and well, it depends. So they're not necessarily looking after the place, and it needs a bit more attention. But at the same
Yeah.
time, obviously, every year you've got to find new students.
Mm.
Whereas if it's a well-managed and a good quality HMO for professionals, and you're providing good service, you can end up having people stay for longer, maybe 2-3 years.
Okay. Yeah. Awesome. Yeah.
Any other questions or comments?
Yeah, Trevor, I've got two questions actually. So the first one is in terms of going for the BRR strategy, when on the refinance step, how much of your capital are you able to kind of extract back once you obviously refinance the property? What is the on your in your experience, what is the range of the finance in terms of percentage
Yeah.
that you're usually able to extract
So
back?
if we're talking, I'm going to give the example based on, we do quite a lot, when we're sourcing properties for investors, we do in an area, we do quite a lot of stuff. We've got our own build teams. So we're doing that in South Wales. And a typical example is the investor will put 100,000 into a project, which could be, for example, 60,000 to purchase, 30,000 to renovate, and then 10,000 of costs like sourcing fees, legal fees, if it's buying in auction, the auction fees and stuff. Will achieve an end value for the refinance of, let's say, 120,000. We get 75% loan to value on that. So on that 120,000, we're going to extract 90,000. So that means there's 10,000 left in. In practice, we're generally talking maybe a bit more left in if it's a hands-off deal, because then obviously there's going to be project management on the renovation. So we're probably talking about 15,000 left in if it's completely hands-off. And if it's completely hands-on, so if you're going sourcing it yourself, project managing the renovation, and you know how to do that, because if you don't know how to do that, you'll end up spending more. But if you know how to do that, or got some experience, or a bit of maybe mentorship or a bit of help on that, you can end up with doing it and only leaving 5,000 in. But yeah, at the same time, if you don't have the time to do it, it's better to get started and leave 15,000 in, because the people that are completely hands off is because they've got a full-time job, maybe getting quite a good income. So by the time, and if we do this really fast, we can do one every 6 months. So by the time we're ready, we've done the refinance on the first one, the investor has already got from their business or from their income basically the top-up money to go into the next one. And when you've got 3 or 4, you don't even need the top-up money, because the top-up money, as long as you're not extracting that, can come from the cash flow from the first ones.
Okay. And I suppose, yeah,
Maybe you had 2
that leads me
questions.
to the last question. Yeah, the last question was in your experience, how did you transition? Because I know, just trying to find a balance between the work. At some point, I'm sure you were working and still doing property in parallel. How did you kind of find the transition? At what point did you just throw in the towel and say, actually, I'm going to go 100% property now because I think I have enough coming in from property?
Yeah, in my case, I mean, because the IT stuff that I was doing, it was more like business development. So it wasn't like an office job. So I could do it remote, and it was in companies that I was actually shareholder, for example, or directly involved. So I could do it when I wanted. So I was from the beginning very hands-on, and also, even though I was buying your standard buy-to-let type houses, I was operating them as serviced accommodation or mini HMOs. to get that rapid cash flow. So in my case, it took me about a couple of years to replace the IT income with the property income. But I was sort of doing it really actively, sort of thing. And I spent probably I would say easily a year of going to these free weekend events, going to property meetings, and also looking in different areas of the country. Because I was looking to start in relatively low cost areas. So at the time I was actually looking up in like sort of Newcastle, Sunderland, Durham type areas. I did look up a little bit, I think up Liverpool area, and then I was looking at South Wales. So yeah, I was sometimes spending 1 or 2 days in those areas, going to PIN meetings or whatever property meetings were there, talking with people. And then I just decided to go for it and get started. Because yeah, that's something you must do as well. If you're doing property, don't spend ages thinking about it. Try obviously learn from others. Don't make too many mistakes, but just get on and get one. I'll say like a little example. We got probably 2 months ago for a couple of London-based investors. They obviously wanted to get started on the BRR thing. Essentially hands off, although they did want to, which is fine, come and visit different properties each time. So we agreed with them. They paid us the retainer fee to start properly actively sourcing, and we were looking primarily at auction properties. But the main reason, not just the fact that we can get them less expensive, but because they wanted to get started fast. And when you get an auction property, it's really good, because if obviously you're successful in the auction, you know that 30 days later you got the keys to the property, obviously assuming you've sorted out the finance or you got the funds to complete, which means it's possible to plan in advance. Almost we can get the keys and have the next day the renovation team in the property. Because in fact, when our renovation team, we've got different people, and we actually use separate group of people that can come in and break everything and get rid of all the rubbish. So we can generally plan for 1 or 2 days after completion, starting on this. So in this case, we were looking at the auction properties, and we decided on one property that the maximum bid was going to be 65,000. I think we got a renovation budget of probably 28,000 plus obviously sourcing fee, and there's auction fees in there. But we said in the end, look, if you want to really get started, go for a little bit higher, because at least then you're getting started, you're getting the momentum going. And we agreed that they go up to 68,000, and we succeeded in getting that property. So yeah, they paid so probably in this first one, they're going to be leaving probably between 15 and 18,000 in it. But they were fine, because they're getting started, they're going to get some level of income and rapidly get on to the next one. So it is sometimes, yeah, a question of, I mean, afterwards, once they've got 2 or 3, we're not going to do that. We're going to say, look, we've got a little bit more time here, and we can plan a little bit more in advance, and we won't go above, for this particular property, 65, or maybe even a little bit less. Are there any other questions?
Hi, Trevor.
Yeah,
Hi, it's Truco.
yeah.
Yeah, so my question is, are you able to take us through your first project? What made you choose it? I mean, your very, very first project. What made you choose it, and what were the learning outcomes throughout the project?
Yeah. So the very first project, by the way, I used a sourcer because I wanted someone that got experience of the area, that would show me properties that had already done some things themselves. So I was prepared to, I think I paid £4,000 at the time for that. And so this person presented me, I think I went twice. I obviously wanted to understand more myself, so I went twice to visit different properties. And then I chose the first one. Because I got this idea of doing serviced accommodation or HMOs, I chose one that had got 2 reception rooms, 3 bedrooms, so that I knew that I could make it into a 4-bedroom HMO.
Yeah.
Yeah, I chose something where there wasn't any structural problems, and it was like a renovation that I could sort of sort out myself. I mean, I had done renovations in the past on my own properties and different things, so I was fine to sort all that out. Yeah, so it's like a relatively low risk one. This one was a probate one, so it took maybe 3 or 4 months to sort out the completion. And yeah, as soon as I got that one, 6 months later, I think I got the next one.
Okay. And did the figures stack up?
Yes. So I remember the first one, I bought it at 50,000. I probably put 1,000 on the renovation. I think I got 1,000 on the reval.
Okay.
So that was almost all the money out.
Okay.
And this
Brilliant.
one, because I was doing like service, I was doing service, mix of service accommodation and type HMO. It was cash flowing between 1,000 and 1,500 per month.
Okay.
Whereas if it's a standard buy to let in this area, when you take off the mortgage amount, is going to be cash flowing maybe 300, maximum 400 pounds.
Yeah.
But I
Okay.
had the time to do it, and sufficient knowledge. I've been to serviced accommodation seminars and things like that, and understood how to do it.
Okay. Thank you.
That's all right, no problem. Is there maybe one last question or one last comment? Right, so we'll finish with that. On the slide that I've got here, we do, or I do, free 30-minute strategy calls. If someone's like thinking of what to do in property and wants to have a chat about it, or someone listening to this recording, feel free to contact us or contact me. That's my WhatsApp number. It's my phone number, but generally phone is not going to do very much, but WhatsApp will work. To book a call where we can basically ask a few questions and maybe help someone help you define how to get started.
Okay.
All right, well, thank you everyone for your time. Have a good evening.
Thanks, everybody.
Yeah.
See you another time.
Yeah,
Thank
we'll
you.
back onto the regular webinars now.
Yeah. Thank you.
Thanks,
All right.
Trevor. Thank you.
Yeah, all right, cheers, bye.
Thanks.